Before the conflict, 178 ships moved through the Strait of Hormuz every day, carrying primary energy supplies for the global economy. This massive physical movement requires a specific financial prerequisite: support from the private maritime insurance market. This diagram shows the three pillars of coverage every commercial vessel requires to sail legally. Owners must secure insurance for the ship's hull, its legal liability, and the costs of potential pollution. Across vessels operating in the Persian Gulf, private insurers carried roughly $352 billion in total liability. Historically, the risk of conflict here was priced so low that war risk premiums were often a negligible part of a voyage's overhead. This near-zero pricing of geopolitical risk provided the low-friction financial environment necessary for the high-volume, low-cost energy transit the world came to rely on. This chart tracks the resulting traffic collapse. Since hostilities began, the 178 daily transits have dropped by 95%, with only 111 total cargo-carrying transits recorded since early March. The human risk has reached a breaking point. With 23 maritime attacks and 11 recorded fatalities, roughly 20,000 seafarers now face a transit where salvage vessels and ports of refuge are no longer guaranteed. In response, the Lloyds Market Association designated the entire Gulf as a high-risk zone. Private insurers began withdrawing coverage, concluding that the threat to crew and vessel safety had exceeded the limits of commercial risk-taking. While missiles are the catalyst for the shutdown, the traffic stops when the financial mechanisms that allow trade to tolerate risk cease to function. If private insurance is unavailable, commercial vessels stay in port, effectively severing the global energy supply chain. To restore the movement of goods, the Trump administration directed a direct government intervention into the shipping insurance market. This diagram shows the scale of the response. The U.S. International Development Finance Corporation established a $40 billion reinsurance facility, moving a massive block of geopolitical risk from private markets onto the United States balance sheet. This marks a shift in the global financial structure, where sovereign governments now act as the primary underwriters for catastrophic risks that private capital will no longer touch. An analysis by the World Economic Forum suggests that this government backstop changes the fundamental nature of global shipping. When the public purse becomes the insurer of last resort, maritime trade becomes subject to geopolitical conditionality. The state gains the power to decide which vessels and which nations are allowed to participate in trade. The WEF poses critical questions for this new era. Would a U.S.-funded facility provide coverage for a European tanker delivering crude oil to China, or for Indian vessels navigating the Gulf? In this environment, the act of insuring a cargo ship becomes a tool of statecraft, used to manage and restrict access to the global commons. Even if a ceasefire is achieved, the demonstrated ability of a state actor to shut down this choke point through asymmetric tactics has been established as a baseline risk for underwriters. This chart illustrates a structural discount cycle. High baseline risk leads to lower vessel traffic through the strait. Reduced traffic results in less actuarial data. Lacking information to model risk, underwriters maintain expensive premiums, which further suppresses traffic. This self-reinforcing cycle adds a persistent structural cost to every cargo leaving the Gulf, long after the immediate military threat has receded. Global energy providers are responding to this long-term risk by investing billions into bypass infrastructure. Projects like the Abu Dhabi crude oil pipeline, seen here, provide a physical workaround, moving oil to terminals that bypass the Strait of Hormuz entirely. Similarly, Oman's port at Duke is becoming a strategic hub because its location outside the strait offers a lower risk profile for international shippers. These investments represent a long-term shift in the world's energy map. The price of geopolitical instability is built into the physical infrastructure of global trade.